Hello, good morning. Hello to everyone. So excited to be here with you yet another day. Welcome to our Monday morning market report, taking a deeper diver into the Central Florida real estate landscape and providing you the latest and the greatest. So today we have an exciting topic to share with you. But before we do that, let me introduce myself. I am Joe. I am the co-founder, co-owner, and property manager with RPM Trusted Hands, and I am delighted to have with us today the one and only Mr. Russ Wazendorf, who is our dear colleague, our dear friend, and he's a renowned, a much respected real estate advisor here in Central Florida, a financial expert with decades of experience and hands-on, experience with with these different industries. And today we're going to be discussing a critical event that took place recently, and this is the Federal Reserve's decision to raise the interest rates yet again, uh, to the highest levels in 22 years on July 26, 2023. So this is a recent occurrence, and this move is sure to have a significant impact on various aspects of the economy, especially mortgages, home prices, and rental rates. So today we are going to look exactly and specifically here in Central Florida. How does this impact everyone involved, agents, but most importantly, you as an investor in this market? So, Russ, I just said a lot. I know this is going to be, we're going to try to keep this short, but as we start, could you explain the rationale behind the Federal Reserve's decision?
Yeah, the Federal Reserve is, as you said, has raised interest rates to the highest level in 22 years. And what they can affect is the short-term rate. They can't affect long-term rates, but they can affect the short-term rate, which means the federal fund rate, which is the rate that the banks are able to loan from the government. And so they've raised that rate by another 1/4%, which typically wouldn't have been a huge number, but the fact of the compounding effect of raising rates over that time period, over the last year and a half, basically, um, has really been an attempt to slow down the inflation in the market. After COVID, there was so much money supply thrown into the market to try to help the economy, try to help a lot of people that weren't in jobs. When you throw that much money supply into the market, there's a consequence, there's a side effect, and the side effect is that you have inflation. And the Fed has a mandate that it has to try to keep inflation under control. And their
Mhm.
mechanism to do that is to raise interest rates. And so what we've seen is this continued raising of interest rates, and it has slowed its pace. I mean, they have slowed how often they do it, and they've also slowed the size of the rate. So this is a 1/4% interest rate hike in order to try to gain control over rising prices and inflation in the market. So that's the attempt that they're trying to do here.
Interesting. Well, Russ, thank you for that insight. And let's focus on mortgages. I think that's what our audience is mostly concerned with.
Right.
How will this rise in interest rate affect home ownership? The home buyers, the power that people have in to be able to purchase their dream homes.
Yes, I mean it definitely has an impact. The good news is that mortgage rates are more forward looking. So typically the mortgage market already predicts the raises of interest rates because mortgage rates are typically 15 to 30 years versus the short-term interest rates that the Fed fund controls. However, that continued increases means that as the Fed funds hits their 22 year high, we should expect mortgage rates to hit its 22-year high, not only
Mhm.
because they just raised the rates, but because there's an expectation that they're going to raise it more. And that
Right.
expectation is the real factor that drives long-term interest rates. So what that affects is, of course, that makes it more expensive to buy a house. That makes it more expensive to your mortgage payment goes up. It makes it more difficult in terms of what you can buy. So you're not able to buy as big of a house for the same amount of money. And so those types of things definitely do have an impact on the market. And in certain parts of the country are going to be affected a lot more than others. Here in Florida, it's as we saw when we talked about our last Monday morning market report, uh, we're still continuing to see higher home prices, but just a more of a plateauing effect. And so this is definitely we're continuing to see that it will slow down the market, though. There will be a slowdown of inventory as these prices continue, these mortgage interest rates continue to stay high.
Yeah, and that's really interesting that you say that because we did say exactly, that plateau effect that we're seeing right now. But with this hike that we're seeing right now, how is this going to impact the home value overall? Now we know how it's going to impact the home ownership and potential buying, but the
Mhm.
pricing itself, how is that going to affect the price, the home values?
Yes, sure. So what we should expect is that it's a two-part effect. So one, we should see the buyers that were planning on going out and buying houses, they are going to there would be a reduce in demand, and that reduce in
Mhm.
demand should drop prices. Um, you have two fighting factors here. You have inflationary pressures and a reduce in demand, and that's exactly what the Fed's trying to do. They're trying to cause pressure, downward pressure on prices. And so that is definitely what intent of the Federal Reserve is, and it does work. I mean, what we're seeing is that there will be a lower supply of houses on the market because less people will be buying, and that
Mm.
is definitely lower demand means also lower in prices. I mean, it's a supply and demand factor. So there is definitely an impact of that. What we're seeing here in Florida is that, as I said, we see that plateau effect.
Yeah, that does make sense, and I think maybe welcome news for investors
Right, right.
in that. So we kind of have the understanding that higher mortgage rates, that means the demand is going to drop, and
Hmm.
that is potentially going to drive the prices down. So let's shift on the rental landscape. How will this hike in interest rate affect the rental market, especially here in Central Florida?
Absolutely. And that's, I think, where you see probably the biggest impact actually is that because it is becoming so much more expensive, especially just the recent change. I mean, the dramatic recent change in interest rates going from 3% interest rates up to close to 7% interest rates on long-term mortgage rates. What that has caused is a lot of people who were considering buying a home or wanting to buy a home either now can't afford it or are considering potentially not buying that home because they're going to hope that interest rates go back down, and so they're looking at moving over into rental. And what you're seeing is instead of that being a downward pressure on prices, it's actually the opposite. You're seeing an upward pressure on rental rates. And what you're seeing right now is demand is increasing in the rental side. You're seeing inventory is decreasing, and you're seeing prices going up on the rental side. And that's something that we've absolutely you and I see it directly because we're talking to people that not only property owners, but we're talking to the tenants that they work with, and um, they're seeing a lot of pressure in not being able to find rentals because the inventory is very low, and that means that they're also seeing higher rental prices, and so those two factors, um, there's other cost other impacts on it. If, for example, the cost of owning a house going up, that cost gets passed along in higher rents as well.
Mhm.
So so does cost of living. That also goes, and so your insurance rates go up. Your input, the costs that go into owning a house goes up. Your utilities go up. All these things are causing upward pressure on rental rates. So rental rates, in my opinion, are probably a lot more impacted than housing rates.
That is, I mean, I think it makes sense 100%, and how just these, it's not an isolated event. This
Right.
is a cascade and a compounding effect into affecting and impacting everyone.
Right.
But for those who are in position, I think this is, a welcomed opportunity to be part of the solution
Mm-hmm.
into providing, increasing the supply on rental homes in already, low supply, inventory. So, well, Russ, I know our time is coming to an end. Thank you so much again for shedding the light on the potential impact of the recent Federal Reserve's decision to hike the rates, and how this is going to impact potentially the mortgage industry, the home prices, rental rates, and so much more. And it is evident that as we're looking at this, these impacts are far reaching, as we just mentioned. But as always, we are encouraging all of our viewers to remain informed and make financially sound decisions. Knowledge is power, and it is our aim here at our RPM Trust the Hands with our various podcasts to equip you with the information that you need at your fingertips so you can remain an informed consumer, especially in this real estate industry. Unfortunately, that's all the time that we have today, but don't worry, we will be back again next week, Monday, with more financial insights. In the meantime, contact us, comment below, interact with us, share this information with others. And until we see you guys again, be blessed.
Thanks, Joe. Take care.
You too.